Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Stocks are on an impressive melt up right now, with the S&P 500 index getting into overbought territory for the first time since August of 2022, before that November of 2021. We're seeing the stock market diverge from underlying fundamentals, pricing in a significant economic recovery right now. This is a chart of PMIs, economic activity staying low, staying depressed, while the stock market is running hot, climbing very quickly. I'm going to show you in this video why this is happening, why this could be a dangerous setup for the market, and what your options are as an investor in this type of environment. I hope you guys are going to enjoy this video. If you do, don't forget to smash the like button and subscribe to the channel if you have not already. Now, without further ado, let's get right into it. Before we start the video, I want to make a quick announcement. We are doing a special offer for Father's Day, where we're giving new signups an extra month for free. So this is going to give you access to all the services that we provide on gameoftrades.net, including all the trades in the model portfolio, where we show our members what the best risk reward trades right now are in the current macro environment. We do providing buy and sell signals for those, and giving you all the guidance that you need around these ideas and a lot of other parts of the market. We installed a pop-up on the website, so you can click on the get free month and you'll automatically get access to the deal. So getting back to the video, evidently the bears are getting crushed here. If you're underweight in equities in this type of strong market rally that takes out a lot of very important technical levels, right? The 4,200 level, that was major resistance. So the market is burning through all of these resistance levels, improving the technical structure significantly. And so you can't help but think whether or not this is a true market recovery, in which case you would be concerned of missing a massive economic recovery right now that's currently getting priced in. Before we take a look at that, let's just remind ourselves that the market is overbought right now. You'll look at the RSI, it has timed lots of important tops in the market, like August of 2022, November of 2021. Now, of course, these marked fundamental turning points for the market, as you had a deterioration of the macro environment throughout these periods. And so these overbought readings marked the moment where markets were priced for perfection and began turning lower following these overbought complacent readings in the market, like we're seeing right now. But you can also see during a bull run, when you get a very extended reading like here in April, this only triggered a small correction in May of 2021. This was only a 4-5% correction before the market resumed its trend higher. The same thing applies for this overbought reading that we had in September. This was a 10% correction, but the market made a higher low and began turning higher. Same thing in June of 2020. Right here, overbought extended reading that triggered a 9% correction, I believe, here. So if you are witnessing a true economic recovery like we had, for example, in 2021, where you had the fiscal stimulus really create an earnings boom that triggered this massive rally on equities, well, these overbought readings just trigger small corrections that eventually come to an end. They're actually great buying opportunities, and then the bull run continues. That's when the macro environment supports the bull run. Now, how can we tell if this is a true market recovery that can actually be sustained? Meaning, even if we have a pullback here following this overbought reading, should we be buying the dip? Should investors be buying the dip and expecting the market to move higher following that dip? That's a very important question. And if we come back to this chart here of economic activity, PMIs, this red line against the S&P 500, you see exactly what a true recovery looks like. The PMIs need to bottom and begin moving higher. The stock market and economic activity move together. They are generally in sync with each other. And so what the market is pricing in right now, as we speak, is that PMIs are going to reverse here and begin recovering significantly. In fact, you can see here the S&P 500 is at a 20% year-over-year gain, which would mean we would need to see PMIs get back to around 55 to 60, which is a strong growth type of environment, in order for this rally that we've seen to be justified. Now, that could very well happen, But to give you some context around that chart, this was a chart that we posted on June 17th of 2022 on gameoftrades.net. June 17th on the S&P 500 was right here at the market bottom in June. And we actually had the mirror image of what we have right now, where the S&P 500 was collapsing, a minus 20% year-over-year change. And so pricing in a lot of bad news very, very quickly in the market. And so basically pricing in that PMIs were going to collapse down to 45 here in the months that followed. And so our argument right here was that the market was pricing in too much bad news, discounting a lot of economic weakness already, and that the risk reward of betting on upside in equities was actually very attractive at that moment. And you can argue that right now we have the mirror image of that, because the market is already pricing in a huge amount of good news. So even if PMIs do begin moving higher here, a lot of that is already priced in. But you can see, for example, in 2012, the market actually did something very, very similar here. 2012, the market priced in an economic recovery while PMIs were trending down. And so investors actually successfully anticipated that economic activity was going to turn up again, and that was going to support the rally. And you can see where that was in 2012. It was right here as the market was getting overbought as well. So that was only followed by a very shallow correction. That was a 10% drop in the market. But of course, it wasn't particularly interesting to be buying stocks right here on that very optimistic move up, because if you look at the returns of stocks following that overbought reading, after around 12 months, they were 0%. The market went nowhere for around 6 months, sorry, not 12 months. But eventually economic activity did turn up and so justified the market rally. The S&P 500 made a very important low here and began to turn higher. So what's an argument for this type of setup where we do see economic activity move up here? One of the things that bulls will point to, so of course the unemployment rate is still very low right now. And if I add the PMI on top of this chart, you can see when the unemployment rate is declining, it means you're in a period of economic growth. It means that you can have cyclical upturns in PMIs when the unemployment market is strong, because people have jobs, they're being productive, they can go out and spend, and so the economy can have these cyclical booms that create market recoveries. Of course, you had that between 2010 and 2018, where the labor market was strengthening, and so throughout this period you had cyclical recoveries that triggered bull runs in the market. And so this is really the argument of the bulls, is that we are still in an economic recovery right now, and so that's going to justify the stock market rally and sustain it. Now the counter argument for that is, of course, that the yield curve is significantly inverted. This means that monetary policy, the Federal Reserve, is very hawkish right now, it's very restrictive, and it's generally bad for the economy. And so this could actually be an early signal that you're no longer in a strong economic environment and that you're actually had a slowdown that is engineered by the Federal Reserve. You can see unemployment typically bottoms when you see the yield curve inverted and begins to trend higher in the months ahead. Same thing in 1989, bottom in the unemployment rate as the yield curve inverts and begins to trend higher. So not an environment where you see PMIs to make these types of strong moves. No, when unemployment is rising, you tend to see PMIs move lower, like 1989, like 2000 here, and of course like 2008 here. And this is a chart that proves that theory out. This is a chart of PMIs following 9 yield curve inversions. You can see we put the same starting point of PMIs after each yield curve inversion. We look at what happened to economic activity following those yield curve inversions, and we almost systematically see that there is a decline in economic activity following yield curve inversions. That's what we've had so far, and if we pay attention to the yield curve inversion signal, it tells us it's not over and that PMIs can actually continue to decline up until around the 19 to 21st month after the yield curve inversion. So that could mean that economic activity could continue to weaken until April of 2024. That's what this chart tells us right here. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed this video. If you did, don't forget to smash the like button and click on the subscribe button if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.